Good afternoon, everyone. Just a few technical difficulties loading things, but we're up and running now. We're just waiting for a couple more people to log in. We will start pretty quickly though. I know people are busy, so we don't want to hold you up. Today's session is about succession and exit planning for business owners in built environment. And built environment, of course, covers a wide area: construction and infrastructure, engineering, surveying, architecture, and a whole stack of other areas. So hopefully there'll be some quite interesting information, and let's get stuck into it and see where we go from here. So firstly, we're going to look at some key trends and just think about the built environment and some of the succession and exit issues that we see with those particular businesses over a period of time. Construction, obviously mining boom, has constrained revenue growth, but there's lots of other opportunities. This data shows us the industry trends over a period of time, and certainly you can see strong growth, pressure on profit margins though, and projected growth going forward for the next 5 years through to 2025 of about 2.3%. So quite a strong, not overly exciting or massive growth, but certainly consistent growth going forward after what has been a relatively slow period. And certainly for those of you in the large capital cities, if you drive around, you still see lots of work going on in terms of, certainly in Sydney, we're building new metro railways, new roads, including some fairly substantial tunnels, heavy rail as well as light rail. We're building a second airport in Western Sydney. There's a lot of infrastructure building going on, but there's also lots of other residential, commercial, home renovations, etc., that are driving that growth over a longer period of time. If we look at the breakdown for the industry, it's interesting just to see the trends. Certainly, as has always been the case, residential building dominates the area. But as I said, there's also lots of additional heavy industry and civil engineering, and certainly some of the other infrastructure-based services being provided as well. Interestingly, if you look at some of the key trends, profit margins is probably the most important thing to focus on. It's certainly improving, but it's been pretty competitive and therefore puts margin pressure onto all providers in this particular sector. Often a tight labour market. That's obviously changed dramatically just at the moment as a result of COVID-19, but certainly tight employment market and lots of demand for good people, and lots of effort to try and attract and retain those good people once you do get them in your business. Certainly in terms of a SWOT analysis, a couple of key things to think about there. There is good, strong revenue growth projected going forward. We've come off the back of low revenue growth over the last sort of 10 to even 15 years, if you look at that, and some challenges there to look at as well. Major markets, obviously private and households, certainly holding up about 50% of the total market, property development, but then also a strong presence of federal, state and local governments in infrastructure programs nationally over the last 10 years. Major players, there are a couple of major players, although in terms of most industries, this is very unusual. There are a large number of much smaller players. No surprise here, really, the distribution of work and establishments, businesses compared to population, it's pretty evenly distributed based on population lines, so nothing particularly unusual there. Key external drivers, I guess, we've got very low interest rates in the market at the moment. Residential home loan rates and commercial lending are both at record lows and have been for some time, and probably will be for some time going forward into the future. So that drives a lot of this activity. Looking at annualised growth by sector now, certainly building, heavy engineering, all around the 2% mark, heavy and civil engineering a little bit higher than that, up around 3%. This is projected through to 2024-25, so basically 4 to 5 years in advance of where we are today. So ongoing, fairly steady, not exciting or dramatic growth, but fairly steady and sustained growth over that 5-year period. Just a couple of key things that are driving that, obviously jobs and growth, profit, all expected to grow over that period. Construction forecast to generate approximately 76,000 new jobs over that period. Now, these figures are obviously somewhat distorted given the changes with COVID that we're in the middle of, or hopefully just coming towards the end of now. But those numbers are still fairly strong going forward, as you can see. In terms of architecture specifically, a large part of the built environment is focused around architectural services. Just interesting to see the size of those businesses. It's a $6 billion market, about 15.5, nearly 16,000 actually businesses in this sector, and 44,000 people employed. I won't go through all of this in great detail. I think most of you already know this, but just to be clear on how we're breaking down products and services across these various industry sectors so you can look at the various trends. No major players in architectures with more than 5% market share. Again, that's unusual. In most sectors, there are larger players that dominate the market, both in construction and architecture. That's not really the case. Again, we've got forecast growth, a little bit slower. Small to medium-sized businesses, again, account for about 98% of this business sector. They will suffer from COVID-19. There's already been, I've got several clients in this space who've already seen a downturn, and probably not work cancelled yet, but certainly delayed. And so that has an impact on immediate revenues. In terms of Macquarie Bank, and I do need to thank Macquarie Bank, we do work very closely with those guys around funding our clients in professional services, and certainly some of the data that they produce regularly in most of the industry sectors they work in is quite useful and valid and valuable information. So reasonable levels of confidence and reasonable levels of expectation of being able to respond well in difficult times. This breakdown of work areas, again, very similar to the large construction type businesses, when you can see the breakdown there, particularly focused on residential and commercial development, etc. Key challenges for architecture, again, we've got the same issue. Fee and margin pressure are certainly an issue, and also the economic cycle is causing some issues. Just having a look at what we need to sort of manage there in terms of where we're at, and particularly looking at key people, again, comes up again. Emerging trends is a sustained construction boom, has been for quite some time, shortage of skilled labour, increase in offshoring, and also some large contracts in terms of large projects being built right across the country, but particularly in Sydney and Melbourne. Turning now to succession and exit, starting to think about the key topic for today is to start to think about business owners in this space and how are they planning for succession and exit as we move towards that stage where business owners, particularly baby boomers, are getting closer to retirement and looking at what preparation they've done. This graph shows you the number of baby boomers turning 65 in Australia per week. And right now we're almost exactly at sort of a little bit over actually, 5,000 people per week turning 65. Now, they're not all business owners, but some of them are. The important thing to point out about this graph is the birth rate continues to increase every single year until we get to 2029. So we're right at the start, really, of the baby boomer wave. The first baby boomer turned 65 in 2011, nearly 10 years ago. And you've seen that dramatic and fairly consistent increase in people reaching that retirement age over that period of time. Important to point out, though, not many people are retiring at 65 anymore. Lots of people working well past that age and well into their 70s in lots of cases. Interesting point to note, most business owners still depending on their business or the sale of their business to actually fund retirement. It's very important for business owners to successfully extract the value of their business, and what the stats tell us is less than half of business owners successfully do that. There's a lot of work needed in this area to make this happen. There's a big funding gap that we're talking about here. Again, going back to Macquarie Bank, we do a lot of work with Danny, who runs the built environment division within the bank, talking about people in businesses where we've got some significant saleable value in there, but most businesses not representing that value properly and needing to cash out of the business or transfer equity as part of a retention model. So just looking at that model, and the key sentence there is right at the end, this process can take time. It's important to start planning well in advance. I've never heard anyone say they started too early, so it is important to start that in advance. It does take a considerable amount of time. Excuse me. Let's look at succession and exit planning. I just want to start with a definition. And the definition is really simply about getting 3 key focus areas right at the same time. So firstly, getting the business prepared for some kind of succession or exit event. Secondly, the financials, both of the business and of the owners or the family. And lastly, personal, and that's around getting the business owner or owners, if there's more than one, prepared and their headspace prepared actually for a successful exit. What does that actually need to look like personally? What are people going to do after business? Assuming we've got the successful business set up and we can extract the financials we need to retire, then what are you going to do when you retire? Obviously, people's life expectancy is rapidly increasing and has been for quite a few decades now. And so if you retire now at 65, you can expect to live for at least 20 years. So it's quite a challenge for people to think about that and think about what they're actually going to do. Most baby boomers that are in business in their 60s would be bored, crazily bored, if they had to just sit at home for 20 years. So what are you actually going to do? The way that we do that is through this 21-step process. We've designed this process over the last 10 years, and there are a number of key elements here as to how that works. And each stage, and there's 5 stages, is part of preparing for an exit event. And the exit event is actually step 18. So it's quite a long way down the process, which just reinforces the fact that there's a lot to do and a lot of preparation required to actually get you ready and well prepared for a succession and exit event. There are a lot of steps in that process that we need to work through to make sure you do 2 things. 1, maximise the value of the business, and 2, successfully exit. Key questions or key considerations for business owners to think about. What's the timing look like? When? When are you actually looking to exit the business? Is it a gradual sell down over a period of time, or is it a sale which is actually on a particular date? Is it when you turn 65 or in 2025 because that's got a good ring to it, or 20 years after you start the business, etc.? Are there employees capable of taking over and owning some of the business? What's the financial business status? What does the business look like financially? Does the owner need the equity to fund their retirement? Because if they don't, if you can get to a point where you don't need that, it changes the dynamic quite dramatically. Future growth opportunities, and in terms of owners, what are you prepared to accept in terms of exit and succession? Certainly important to understand some of the exit options that are available to us. And this slide talks through the exit options moving up from the bottom left, which is family, friends and fools. Cheap, easy, simple, quick, but never a good way to maximise sale potential price. As you move up and to the right then, you will see they become a little bit more complicated, take a little bit longer, a little bit more work involved, probably external advisors involved as well, until you get right up to the top options. Now, the top options for most small to medium business owners, they're not a valid option. You're not in a position where you're likely to be able to list your business in an IPO, and you're possibly in a position where you might be able to achieve a strategic sale or sale to a listed company, etc. Private equity, venture capital, trade sale, a few of those are key strategic exit options for business owners. Certainly anything from sell to other shareholders up to strategic sale are good options. And they're good options because they are A, achievable, and B, a good combination of sale price and value with complexity and effort as we move through the process. So they do take time. Anything above selling to other shareholders, you're talking months and potentially years. And certainly at the top end of the spectrum, trade sale, private equity, strategic sale, you're talking at least minimum of 6 and probably more likely 12 to 18 months to prepare properly to maximise value when you do that. Let's talk about employee share plans. They're becoming far more popular as an exit option. I'm doing a lot of work, research, particularly in this particular area around using employee share ownership plans as a succession tool. So let's have a look at some of the research and background around how this particularly works. It's all built on the underlying premise that businesses like these are focused on people. All of the services that we provide, my business included, are delivered by people, one-on-one, in groups, doesn't matter, but key people are very important to professional services firms. And you need to have successful execution depends on people, but it's equally important that you attract the right people, that you retain them, and that you can reward them, not always just through increased salary, to make sure that they're aligned with you in terms of the business and its performance outcomes. We see benefits from an employee share plan, certainly as a funding option for exit or succession. Certainly as part of, not the only avenue, but certainly part of being able to deliver improvements in financial performance. Certainly lots of business owners, particularly baby boomers, very concerned to make sure the business continues after they exit. And certainly that's important in this particular area as well. And lastly, there are some tax concessions available to employee share ownership plans upon the transfer of ownership. So we get that benefit as well. I won't read through all of this. Obviously, these slides will be available, and this session is recorded, so you can replay it at your leisure. But a couple of key things. Certainly, this has to be based around a win-win-win. The win has to be the business or company itself, the owners or existing shareholders, and the incoming employees. It's all about making sure that we get that successful performance across all three levels. Win-win-win, which simply means everybody's better off, and therefore the plan will be far more successful over a period of time. Let's look at the model we use. It's called a peak performance trust. We've designed this and modified it several times over the last 10 years. In fact, the first one of these that I implemented was dated 2006, and it still exists in a real estate business. It's been running for quite a long time. It's got quite a number of employees working through that business. Key premise here is to start to get your employees to think and act like business owners. And in terms of the structure, I'm going to walk through an example or a case study of how that actually works. But the simple model is we're inviting our key employees to join the Peak Performance Trust, which sits in the middle of that screen. It's a separate legal entity, which is an employee share plan. The founders have set up the company, invited the employees to join through an employee share plan, and the employee share plan very simply owns shares in the business. That's how they work. A couple of key things to start to think about in terms of how the plan works. Firstly, we normally use a profit share model. We normally benchmark the business profit and then share a portion of that improved profit. But when we say share it, we're not paying it out, we're actually paying it into the employee share plan. We then invite our employees to join, and there are set rules under the employee share plan, the Peak Performance Trust, which covers things like how you join, how you leave, valuation, cashing in when you're not an employee anymore, retirement, etc. Over time, that company then pays the profit share amount into the Peak Performance Trust. The only thing the Peak Performance Trust is allowed to use that money for is to buy shares in the underlying company. And so gradually, employees are using that profit share plan to fund their acquisition of shares in the main company. If the company pays dividends, obviously the employees benefit from that. Importantly too, as the company grows in value, the employees get the benefit of that capital gain, which is something most employees never have in terms of existing businesses. Let's have a look at an example. This is a business, we're going to call it Smith Trading. It's owned by John and Jane. We have up on the top right-hand side, we've calculated our profit benchmark for 2019, and we've actually exceeded that. So our benchmark was $500,000. We've actually exceeded that by making a profit of $600,000, $100,000 excess. We're paying 20% of that into the Peak Performance Trust. Now, importantly, if we don't meet that benchmark, there is no payment. So no profit share gets paid across to the employee share plan unless we meet the benchmark and in fact exceed it. Bottom left-hand side, we've now calculated that we need to pay $20,000. That's actually physically paid from the employer company into the employee share plan. The employee share plan, the only thing it's allowed to do with that is buy shares. Where does it buy shares? The only place it can buy shares is from John and Jane because they're the shareholders. And so the money actually moves from the company into the employee share plan. Importantly, that's tax deductible to the company, but it's not taxable income to the employee share plan, and it's deferred tax for the employees. So there are some tax benefits to doing this. The money, of course, then goes up to John and Jane Smith to buy their shares in Smith Trading. Now that model and that example just happens year on year. It continues to happen until we get to a point where we either reach a cap. We might have said that our employees can buy 20% of the business, or some of my clients, including a few in the built environment space, are actually using it to the point where they buy the entire business through the employee share plan. The idea is we've got a self-funding mechanism, so we're not reliant on employees' individual financial capacity, where we can allow employees to gradually buy equity positions. Again, gradually is important, it takes time, without necessarily prejudicing based on who's got capital to buy and how we manage that, bringing on minority shareholders as individual shareholders of the company. It's actually done through the employee share plan, so it's an ordered, structured approach to how this should work. I'm going to pause now and very happy to answer questions. Let me just make sure that if people do have questions, I'm very happy. There's a chat box you can type them into. I'm also very happy for you to unmute your microphone and just ask them out loud. Everybody can hear, and I'm happy to answer those. I'm also going to give you my contact details, so I'm very happy for you to email me with questions separately if you don't want to ask them live. But if there are questions, very happy to go through them now. We've got a couple popping up already. Yeah, okay, so the first one is around the time that it takes to prepare an employee share plan. Generally speaking, it's a 2 to 3 month process. We wouldn't like to do it any quicker than that. 2 to 3 months because there's actually 3 stages in the process. The first stage is what we call an insights report, which is really around evaluation, but also a full analysis of the business, structural, CGT, who owns it, financial, so financial performance, we look at benchmarking, cash flow analysis, sustainable growth rates, break-evens, benchmarking against industry averages, obviously evaluation. We also look at the non-financial aspects. So we're looking at operationally, how is the business managed? What do the risks look like? What documentation do we have in place? Does any of that need to be updated or improved as part of the process? And if it does, maybe we need to do that before we implement the employee share plan. Stage 2 then is around design, but also education. So we run a workshop for employees to make sure employees understand how the plan works, how the taxation works, and what their obligations and rights are under the plan as well. And then lastly, the last month is actually just implementation. It's around legal documents, setting up the trust deed, making the rules are in place, making sure, the rules are in place around entry, exit, valuation, dividend payments, etc., so that everything's covered off. Might be next question. Might be a rude question. How much does it cost? Okay, it's not a rude question. It's obviously pretty important. Generally speaking, that 3 month process, as I said, is a cost of about $25,000, including disbursements. It's broken up into the various stages, but overall, if you budgeted between $20,000 and $25,000 to implement a custom designed employee share plan for the business, that would definitely cover the cost. We have a payment arrangement where you can pay that over 12 months, and it's generally speaking pretty good value in terms of the potential cost of employee turnover. If you've got employees that are leaving the business, the research is typically saying that that generally would take something like 40% of an annual salary to replace that person. Any other questions? I'm just going to pause for a moment and check any other questions, or does anyone have a question they'd like to ask out loud rather than in the chat box? Okay, there are no other questions at this stage. Let me just go through a couple of resources for you that you can access. Firstly, there is a white paper that we've written specifically on the built environment. It's downloadable, there's no cost or anything. You just go onto our website and put your details in. We'll email you the white paper. It's about 15 pages long and highlights a lot of the trends we've talked about today, but also some of the exit and succession statistics around the built. It's industry specific to built environment, so that's quite useful. If you haven't seen that, I suggest you go and have a look at that and download that. I've also written a book on employee share ownership plans, which is 3 basic sections around the academic research behind employee share plans, the technical tax and accounting treatment of employee share plans, and lastly, just some case studies and practical application around how do share plans work in small to medium sized business here in Australia, including some live case studies of clients we've worked with previously. Again, on our website, so if you go on the website, look at the content library, there's a section for ebooks. You can download that ebook straight from the website. You can also get a hard copy if you want to email me. You can buy them on Amazon or whatever, but if you want to email me, I'm happy to send you one as well, if that suits. There's my contact details. If you do have questions that you didn't get a chance to ask today in the forum, I'm very happy to answer them privately, either by phone or email. And as I said, if you do want a copy of the ebook, please just flick me a note, and I'm very happy to send that to you directly. Any other questions before? Yep, okay. We do have another question. So, are these plans valid for businesses with a turnover less than $1 million? That's a really good question, and I often get asked that one. What sort of size business do these plans suit? I've got several of these plans where they've just got one employee in. So I've got a couple of businesses. I've got one in, for example, that turns over about $300,000, and they've got one employee inside the employee share plan. So I think it makes sense for small businesses. As I said, if you compare what it would cost you to replace a good employee, if you've got someone earning $100,000, 40% for 40 grand, by the time you pay for recruitment fees, lost productivity, retraining, etc., it's quite valid to look at that. So yes, it's 25 grand costs. You paid over 12 months, but you're locking in that key person. You're saving yourself a lot more than $25,000. But you're also really designing and documenting and locking in your succession and exit strategy based on that employee. I'm happy to have a look at it for you and make sure that's correct for your particular business. But generally speaking, as I said, we've got quite a few of these plans that are designed specifically for small businesses. Any other questions before we wrap things up? I do want to keep fairly closely to time frame. I know we've got a little bit of time left. I'm happy to answer questions if there are any. Otherwise, I'm very happy that you joined us. Thank you for coming along. Contact details on the screen if you need more information. And there are plenty of resources, as I said before, on the website, which you can access for free. Thanks again for joining us. Hope that's been helpful. I look forward to catching up with you soon.